2018 was a difficult year for the stock market. Even after factoring in dividends, the S&P 500 produced a negative 4.4% return for the year. The other major indices didn't do much better, and many individual companies did even worse. However, one company did beat the S&P 500 and has for 10 of the past 13 years. So let's take a look. So here's a clue for you. Yes, it's Warren Buffett. And Berkshire Hathaway, the conglomerate led by Warren Buffett, delivered a 3% gain for investors in 2018. This means that Buffett and his team beat the market last year. However, the really impressive statistic is that Berkshire has now officially beat the market an impressive 10 times out of the past 13 years. It's a well known fact that among investors, Berkshire has a long history of strong performance. Since Buffett took over in the mid 1960s, Berkshire has delivered annualized returns of more than 20%. While it's certainly true that the most impressive returns occurred early in the company's Buffett led history, when it was a relatively small operation, you might be surprised to learn that this half-trillion-dollar conglomerate still beats the market consistently. Here's a look at Berkshire's recent performance versus the S&P 500. It's interesting to note that the performance of Berkshire includes a variety of stock market conditions. It includes part of the pre-financial crisis bull market, the dismal 2008 crash, the record long bull market that followed, and the recent corrections. The three underperforming years for Berkshire weren't in just one type of market. 2009 was a great year for the market, but 2011 and 2015 were not. And as you can see, Berkshire Hathaway beat the S&P 500 10 times in the past 13 years. Berkshire beats the market often because Berkshire's businesses are designed to generate outstanding returns on equity. Berkshire also uses money from its insurance operations to fund growth, and Buffett has a knack for spotting value in the stocks he buys. However, there's a simpler explanation. The priority of Buffett and his team isn't to beat the market every year, although market beating performance is certainly one of their long term goals. Instead, Berkshire's managers aim to, number one, increase Berkshire's earning power every year. In other words, the earnings potential of all of the company's businesses and investments should always be greater than it was the year ago. Number two, management also wants to increase Berkshire's book value every year. In fact, Berkshire's book value has increased in all but 2 calendar years since 1965. On a valuation note, although Berkshire's stock price has increased by 248% over the past 13 years, it's actually trading for 12% less relative to its book value. Number three, Berkshire wants to avoid taking big hits when the market does poorly. Over the past 54 years, the S&P 500 has produced negative total returns 12 times, and Berkshire Hathaway has beat the index in all but 2 of those down years. And lastly, Berkshire adds businesses and stocks to the company's portfolio while paying less than they're truly worth. This is the secret sauce. Buffett has an uncanny ability to find acquisitions that add more value than their purchase price. The combination of these principles has allowed Berkshire to produce amazing returns over time. Of the first 53 years with Buffett, Berkshire's stock price increased by more than 20% in 28 of those years. And while it wouldn't be realistic to expect a 2,400% total return over the next 53 years, even as a half-trillion-dollar company, Berkshire still beats the market more often than not. With more than 60 subsidiary businesses and a portfolio of more than 40 stocks, it's like buying a diversified portfolio all in one stock. And it's a diversified portfolio with a proven track record of delivering market beating returns over long periods of time. So pay attention to the lessons that we can learn. And for today, that's Chew Dog Charts. Thank you.